Welcome once again to When the Facts Change, economics and politics in a fast-moving world, with me, Liam Halligan. Now, where is UK inflation going? And at a time of huge political flux and domestic turmoil, what is the future of the Bank of England and also the official fiscal watchdog, the Office for Budget Responsibility? Having reached a 40-year high of 11.1% in the autumn of 2022, UK inflation has since been falling. On the 18th of February, we learned the Consumer Price Index rose 3% during the year to January. That's lower inflation than we've seen, but still well above the Bank of England's 2% target. Now, since Labour came into office, the Bank of England's cut its main policy rate from 5.25 in July 2024 to 3.75% since last December, with the 9-member Monetary Policy Committee voting for 6 successive rate cuts. Controversially, even though the Bank of England is supposed to be independent, the government's tried to claim credit for lower interest rates. But the reality is that Labour's high borrowing, high spending policies, plus sharp increases in employer taxes and the minimum wage have actually helped drive up inflation, making it harder for the MPC to cut interest rates. And since the 2024 election, UK inflation, bang on the 2% target when Labour took office, has been much higher than the Eurozone average and easily the highest among the G7 economies. To discuss the future path of UK interest rates, as well as the state of our public finances and economic policy making more generally, I thought it was time to talk with a serious heavyweight. So I asked Andrew Sentance to join me here on When the Facts Change. One of Britain's leading economists, Andrew served on the MPC from 2006 to 2011, earning a reputation as a robust, independent thinker who kept focused on fighting inflation. UK inflation remains high and our public finances remain fragile, with even the Institute for Fiscal Studies now arguing Britain needs to rethink its fiscal rules. So stand by for a no-holds-barred discussion with a genuine policy-making insider, albeit one with the freedom now to speak his own mind. Here's Dr. Andrew Sentance on When the Facts Change. Andrew Sentance, great to have you here on When the Facts Change. We've just seen a UK inflation number. It's still well above target. What do you think about that number? Did it surprise you? And how should the Monetary Policy Committee respond?
Well, inflation has been pretty volatile recently. Certainly the annual rate, it was up at 3.6, then down to 3.2, up to 3.4. Now it's down to 3.0. But I'm not sure that it's coming down on a very pronounced trajectory towards 2%. I think it's quite possible that we'll get stuck somewhere over 3% as we go through this year. And I think it would be premature for the MPC to think that just because inflation has come down in this month, it's going to come down in the next few months because it's been so volatile recently.
Of course, we've seen a succession of rate cuts since the middle of 2024 from 5.25 down to 3.75 by the Monetary Policy Committee. Why is inflation still so far above the 2% target? Where are these price pressures coming from, Andrew?
Well, we've had a persistent period of high inflation. It went up to 11%. And though it's come down recently, if you take the last 5 years, inflation averages 5%, which is 2.5 times the target. And people have become accustomed to high inflation. And some of the low inflation behaviour that got ingrained in the UK economy over the period from the 1990s onwards has slipped away. I mean, in economic speak, inflation expectations have shifted upwards. So we can't guarantee that everyone is going to behave as if inflation is 2%, because there's a lot of evidence in the outside world telling them that things are going up faster than 2%. And so in the labour market, for example, the average wage increase is still 4.5% or just below. Services inflation, which hasn't come down as much as goods inflation, is still around about 4.5%. So we've got a world where people look at what's happening to prices and they see prices in some areas rising at 4 to 5%. And they see often what the government is doing in terms of public sector pay and in terms of some of the prices that government is responsible for, those also going up much higher than the 2%. So I think we've moved away from a world where inflation can be reliably 2%. And the MPC haven't sent the right signals to the private sector to show that it is determined to get inflation back down. It's been cutting interest rates when really it should have been holding them steady for longer.
Let's just drill down a little bit into the service sector, which you mentioned. Service sector inflation underneath the headline CPI number, as you state, still 4% plus. This is 75-80% of our economy, right? Here in the UK is services. Describe, Andrew, how higher wage rates, how higher national insurance contributions, how higher energy bills, utility bills for firms can boost that service sector inflation.
Well, we used to be in a world where productivity growth was 2.5% in the UK economy. And so we could rely on, if there was wage growth of 4 to 5%, we could rely on productivity growth to offset about half of that. And we could still get 2.5% inflation.
So firms will get more output for the extra wages they're paying, which will keep the lid on inflation.
Absolutely. So higher productivity growth helps to keep down inflation.
Indeed.
But we've moved to a world where productivity is somewhere between 0 and 1%. And sometimes it looks as if it might be negative. So we're not getting the productivity growth that would normally offset wage growth. That means wage growth has to be held down to round about 3% maximum in order to deliver 2% inflation. And that actually happened from 1998 until 2019, before the pandemic. But we've lost our bearings in terms of that sort of rate of wage growth. Now, in the services sector, productivity growth is not as strong as it is in manufacturing. So those problems of lack of productivity growth are even more acute in the services sector. So it's not surprising that in the services sector that actually inflation is round about the level of wage growth, because labour is also a very important input into the services sector activity. So we can't rely on productivity growth in the services sector in the way that we can in some other sectors of the economy.
You gave a speech recently in Oxford. You were quite critical of the Monetary Policy Committee, which of course you served on with distinction from 2006 to 2011. So how do you think the MPC has conducted itself en masse in recent years, particularly in the aftermath of COVID? Because it strikes me, Andrew, as I wrote at the time, it took the MPC a long time to get its head around the fact that there was going to be, a post-COVID inflation spike. We kept hearing a lot of this word, didn't we? Transitory.
Well, I think the problems go further back, actually. The MPC, which cut interest rates when I was on the committee down to very low levels, and that was exactly the right thing to do in response to the global financial crisis, didn't have a plan in the 2010s for getting interest rates back up to some sort of what you might call a new normal level, somewhere sort of close to 2% or around about 2%. Whereas in the United States, for example, they had a plan which they implemented through the sort of mid-2010s of getting interest rates up to about 2%. So the signal sent out to the great British public was that interest rates were going to stay very low almost indefinitely, because the MPC, even when it did raise interest rates, only raised them to the staggeringly high rate of 0.75%.
Steady.
And then brought them down again in the pandemic. So we had the first thing I think that went wrong, we had too long a period after the financial crisis of very low interest rates, which conditioned people to think that interest rates were going to be much lower into the medium term than they really ought to have been thinking. Then in response to the pandemic, I think the MPC overreacted. They injected quite a lot of extra quantitative easing, which wasn't really required because government fiscal policy was doing a lot of the heavy lifting in terms of helping the economy through the pandemic. So the MPC relaxed too much during the pandemic and then were very slow to recognise, as you've said, the dangers of higher inflation as we came out of the pandemic, because the growth rates of the economy were then very strong. Supply chains were disrupted. That bounce back met a lot of bottlenecks, supply chain problems. A lot of resources and components were in scarce supply. And so we had this global surge of inflation. But the MPC were relatively slow among monetary authorities around the world in picking up on it. So it was only by sort of the end of 2022 that we got interest rates up to some sort of sensible level. It took them an awful long time to get there. So there was a series of mistakes on monetary policy. And those mistakes, in my view, meant that when inflation needed to come down, the MPC should have been focused on making sure that it was going to come down and stay down. Whereas they took the first signs of a fall in inflation, 23, 24, as the reason for starting cutting interest rates. And they were premature in doing that. And the chief economist at the Bank of England, Hugh Pill, has now effectively acknowledged that. In his view, he said we were too hasty in terms of cutting interest rates. So they've cut interest rates now in anticipation that inflation will come down to 2%. But if it doesn't come down to 2% and stay there, the MPC will have seen to have made another mistake, which is by being premature in cutting interest rates.
I want to carry on discussing the MPC, its recent actions and what it should do now, Andrew. But just before we carry on with that, if I may, let's go back to QE. You remarked that during lockdown, the MPC implemented a huge increase in quantitative easing. I think we did more quantitative easing in a year, 18 months during lockdown than we did in the previous 10 years. So we did 450 billion during lockdown compared to 425 billion pounds of additional digital money, if you like, created. What do you think of this? My sense, and I've argued this over a period of time, but does this chime with you? My sense is that the difference between QE1, non-COVID QE, and QE2 is that QE1 stayed broadly in the financial system and boosted, stock prices and some high-end house prices in parts of London where bankers and hedge fund managers live, but it stayed broadly inside the banking system. But QE2, money created, was sent basically directly to the bank accounts of firms and households via C-bill loans during lockdown and indeed furlough. That's why QE2 was inflationary, the sort of second big wave of quantitative easing during lockdown, whereas QE1 was only inflationary in terms of financial assets and house prices, not the broader economy. Do you think that's broadly right?
I think it's right to say that financial markets are a very important part of the transmission mechanism for QE. What I feel about the experience of QE after the financial crisis, when I think it was necessary and I supported
2009 onwards,
that's right.
Yeah.
I supported it when I was on the committee. But its main effects were through financial markets and through confidence. In a sense, people saw central banks doing something that they hadn't really experienced before. And it was a bit like the thing that you used to have in your classroom at school by the door. It said, in case of emergency, break this glass. And it was like the central bankers breaking the glass, doing something, doing something that we hadn't done customarily before. But that sort of confidence effect, I think, wears off over a period of time. So as we got repeated rounds of QE, I think they just became less effective. Now, they still generated money which was sitting around in the system. And I think the danger of that is that this money could become active at any point in time. And therefore it's something that central bankers should be mindful or should be trying to sort of take out of the system before it becomes an inflationary threat. And I'm not sure that we did that. I mean, we put more money in the pandemic instead of reducing the amount and reducing the inflationary threat.
This latest MPC decision, this latest inflation number, what would you say to the diminishing number of people who have mortgages? Only less than a third of UK households now are owned by people who are paying off a mortgage. More are owned outright. And of course, the rental sectors. I wonder the extent to which interest rates actually do impact consumer spending these days. But maybe we can talk about that. But what do you think of that? What's the outlook now for the bank's policy rate for those people watching who do have mortgages, who do have personal loans?
Well, even though there are some on the MPC who are pressing for further reductions in interest rates, I think coming from where we were at 5.25%, the bulk of the interest rate reduction in terms of bank rates are behind us. So we've come down to 3.75%. We might come down to 3.5% or 3.25%, but the bulk of it is behind us. What sort of individuals probably need to look forward to is for that to feed through into the rates that they're actually paying, because many people are on fixed rates. So those reductions won't come through straight away to all households. So I think the task for the MPC should be now keeping interest rates more or less steady for quite a period of time, in order to see how the economy adapts and to see what scenario unfolds for inflation. Because as I said earlier, we're not guaranteed to get back to 2% inflation. And if we don't get back to 2% inflation, the MPC may have to take further action in order to bring it back there.
But to be clear, if you were a member of the MPC now, you wouldn't have been cutting rates recently. You wouldn't be arguing for more immediate rate cuts.
No, I would have been one of the hawks in the MPC. I always find myself on that side of the debate. I think that one of the roles of the MPC is to take monetary policy decisions that the politicians will find difficult. And if they're always doing what the politicians would like them to do and expect them to do, it may be they're doing the wrong thing. And I think the approach to interest rates over the last 18 months or so has been to cut them too readily. I think the MPC should have been a little bit more grudging in waiting for evidence that the inflation rate is going to actually get down to the target or get close to the target, rather than cutting rates in anticipation of that.
We had a recent speech from Robert Jenrick, who's now installed as Reform's, putative chancellor, shadow chancellor, they call him, though of course Reform isn't the official opposition. He said that the Bank of England will stay independent under Reform, as and when there's a government involving Reform. How would you change the MPC, Andrew? How would you change the appointments process? How would you change the kind of constitutional setup of monetary policy?
Well, there's a few things I think we need to look at on the MPC. Certainly not diluting its independence in any way. If anything, that has been, I think, eroded by stealth over the last 5 or 10 years or so. One thing the government should look at is the mandate letter for the MPC, which has become very over-complex. And I think we need to go down to a much simpler mandate, which really just says to the MPC, you've got to keep inflation at 2%. If at all possible.
So there's no room for a kind of Federal Reserve style dual mandate where the MPC also targets employment growth and economic growth more generally. Can we not afford that?
I don't think that can work in an economy like the UK, which is so open to international influences.
Indeed.
They can do that.
We're not a reserve currency the way the US is.
No, exactly. We can't operate as unilaterally as the United States Fed can. But there's some other things I would do. For example, I think consideration should be given to shifting the balance of membership on the MPC so that there are more external members, people who've got experience outside the Bank of England, than internal members. So we could have, instead of the 5 internal members who always have a majority
of the 9,
of the 9, maybe we should have 5 or 6 external members, and then only 3, perhaps the governor, the deputy governor responsible for monetary policy, and the chief economist, who are the internal members. And that would bring in more diversity of opinion, and would also, I think, help because the external members have a much wider range of experience. And the other thing I would do is with the appointment process. The appointments are still made by the Treasury, effectively. And I think we should have an independent appointments commission for the two main economic bodies, the MPC and the OBR. And those appointments should be done by experienced people who are from outside the political system to choose the best equipped and the best qualified people in those roles.
I agree with all that, and it strikes me that the problem with the Bank of England isn't that it's independent. It strikes me that now it isn't independent enough.
Well, that's a very good observation. It's not that there's some sort of hotline from the Treasury or any other political source towards the MPC. When I was at the MPC meetings, the Treasury representative sat by the door, and I always used to say that so we could throw him out, or him or her out, if we needed to. But there is some sort of unseen type of accommodation of the political debate. And when the headlines are screaming for interest rates to come down, when the Chancellor is getting up every 5 minutes saying, I hope we can cut interest rates, that's not a very healthy background for the MPC to do its job properly.
Indeed. Do you think it's counterproductive when the Labour Party pats itself on the back because the MPC's cut interest rates, getting on for half a dozen times since they came into power in the summer of 2024?
Well, I wish I could say that it was their policies that had enabled the MPC to cut interest rates. I think it's not Labour Party policies, which have generally been quite inflationary, with increases in borrowing, increases in government spending, increases in taxation. All those things are actually potentially quite inflationary. So I don't see...
So we've seen these rate cuts despite Labour?
Yes, I think it's probably a better way of putting it. Interest rates have come down, but I think the MPC has taken a bit of a gamble on cutting interest rates. And it's not necessarily on the basis of the current government's economic policies that they've been able to do that.
So we've been talking about monetary policy, the setting of interest rates by the Bank of England's Monetary Policy Committee. Let's move on to fiscal policy. You mentioned the OBR earlier, the Office for Budget Responsibility. Andrew, people that you and I know well, people that we respect as professional economists, have been comparing the UK's current situation to the months before 1976, a huge moment in British economic history, policy-making history. I know it had a big impact on you as a young economist. It certainly had a big impact on me as a small boy, watching it on television, watching the implications for small business people in the community that I grew up in. Economists who are warning that we're on a path to 1976, a bailout, a proper lurch on government debt markets in the UK, are they right?
Well, I certainly think the risk of a serious economic and financial crisis for the UK has been rising under this government. No two economic crises are the same, so they don't necessarily take the same form. They may affect currency markets, they may affect bond markets, they may affect stock markets. So we don't necessarily will have a sort of rerun of 1976. But if you look at what has been happening on the fiscal policy front, borrowing levels have been ratcheted up, government spending totals have been ratcheted up, and tax rates have been ratcheted up. Now, that all happened in 1974 and 75, ahead of that 1976 crisis. That was the sort of policy mix that Dennis Healey was pursuing in 1974 and 75.
So then Labour Chancellor of the Exchequer.
When he was Chancellor of the Exchequer. And it was only through the turbulence on the financial markets that led him to go to the IMF, and then he had to change direction and had to rein in public spending and rein in public borrowing. Now, the interesting thing about that is that after he'd done that, the UK economy recovered quite strongly in 77 and 78, and inflation came down. And if the government really wants growth and if it wants to have sustainable low inflation, it would be in its interest to rein in public spending, to rein in public borrowing, and to avoid further tax increases. But there doesn't seem to be a recognition of that in the current economic policy setting circles in the Labour government. So we may well be heading for some sort of economic and financial crisis unless there is some change in economic policies.
How do you think the markets will react if Keir Starmer is replaced by somebody firmly from the Labour left? Prime Minister Rayner, for instance, Prime Minister Andy Burnham, for instance. Do you think the markets will take that in their stride, or do you think there will be a significant response from the big international creditors, the pension funds, the insurance companies, the sovereign wealth funds that lend big governments serious money?
Well, I think we've already had quite a few leftish policies under this phase of the Labour government. So there's a question about how much further left could another leader really go and maintain the confidence of the financial markets. So I think if there was a change in the leader of the current government, that would be also accompanied by perhaps more turbulence on the financial markets, and that would act as a disciplining effect, as we saw in the 70s on the government. So we would have to see how all that panned out. But certainly it wouldn't help if there was a sort of change in the leadership of the government that's threatened more uncertainty about policy, and perhaps threatened even further increases in public spending and borrowing, and therefore potentially further increases in taxation.
But you're a very serious, credible person in the UK's economic debate, if I may say so. What you say will carry particular weight, and what you're saying, Andrew Sentance, it seems to me, is that talk of 1976 is not outlandish on our current glide path, if you like. And if Keir Starmer's replaced by somebody further left from the Labour Party, that talk would become even less outlandish.
No, I think that's a good summary. So far, Rachel Reeves has pursued not dissimilar policies to the ones that Dennis Healey, the Chancellor in the mid-70s, did. So there is an element of history repeating itself, and her approach has been very different to Gordon Brown when he came in 1997.
Yeah, the early part of Gordon Brown.
Yes, the early part of Gordon Brown.
Because then he ratcheted up borrowing. He wanted to spend his way to a popularity that he would never actually have, it strikes me.
Yes, that came in sort of around about 2003, 2004. Yeah. But we had quite a few years.
We did, to his credit.
Of quite sensible economic policies the last time a Labour government came in. But it seems that under this government, those lessons haven't been heeded. And we're back to the more Healeyite type policy.
Like you, I talked to a lot of people at the top of the Labour government back then, and I can confirm, as I'm sure you can, they were absolutely adamant, and Brown was absolutely adamant, and fair play to him, to banish the ghosts of 1976.
Mm-hmm. Yep.
I remember Brown coming up on stage at the Labour Party conference just before the election in 1996, and there were literally pictures of Dennis Healey in the introductory video, and the message was in black and white, and then you had Brown in colour, and the message was absolutely clear. And Brown did make Labour electable again, in the sense that so many people back in the late 90s remembered 1976 in a way they don't seem to now, if I may say so, with obviously some honourable exceptions. So how would you change our fiscal rules, Andrew Sentance? How would you change the OBR? Again, Reform, for what it's worth, have said they will have fiscal rules. They will keep the OBR. I know they're very mindful that what they don't want to happen is, Reform get elected and there's an instant bond market collapse, which would obviously put our democracy in real turmoil. It strikes me, as well as our financial management, our public finances. and so on. So what would be Andrew Sentence's advice to the way we can change the OBR, change the fiscal rules, because the current system clearly isn't working?
Well, I think there are two aspects to that. One is the fiscal rules themselves. And by sort of stealth, Rachel Reeves managed to weaken the fiscal rules when she came in.
Almost unremarked upon, as you said.
And they operate, insofar as they do operate, on the basis of forecasts for 5 years ahead. Well, those forecasts move around a lot, and also it's very easy for the Chancellor to say, well, I can relax things a bit now because I know I'm going to rein in public spending or raise taxes or something in the future. I call that the Manana school of economic policy, and it's operated in many South American countries, but not normally in the UK. So we need to banish that Manana school and have fiscal rules that actually operate in a 1 to 2 year time horizon. Even if the ultimate objective is to get borrowing down to some sustainable level in 3, 4, 5 years' time, there must be progress over a 1 to 2 year time horizon in that direction. And the OBR should be really quite hawkish and on the ball about pointing out if that is not the case. And in order to do that, we need to change or strengthen the composition of the OBR, which is really, in terms of its decision-making structure, is only 3 people. We need a wider group, and we need to reconstitute it as something like an independent fiscal commission with the members appointed through some sort of independent and much more transparent process.
As with the MPC.
As with the MPC.
It would be the same body.
Yes, we could have an independent economic appointments commission.
And people like you could be on that.
Well, I've done the MPC, but I could do the OBR.
No, you could be on the appointment.
I could be on the appointment.
Because you obviously know the economic and political landscape, and you've got with huge respect, you're mainly retired these days. You won't want the job, but you will have huge knowledge. People like you will have huge knowledge of who the right person should and who the right people shouldn't be.
Absolutely. But the challenge, I think, for a government that wanted to move in that direction would be to do it in a way that doesn't appear to be softening the rules. That
seems to be tightening, like a hair shirt.
Yes.
So do Reform need to adopt a hair shirt? Do the Tories need to adopt a hair shirt?
Well,
whoever to stand up for fiscal
whoever's
reality?
going to come into power, I think, needs to tighten up the fiscal rules in some way, and possibly tighten up the procedures by which we appoint members of the OBR.
Now, you're a distinguished economic forecaster. We've both done a lot of economic forecasting in our lives. We've got very nerdy, multiple degrees in this stuff, right? But we both admit, as public-facing economists, if you like, forecasting is really, really, really hard. And it strikes me, Andrew Sentence, if you are trying to make a forecast about what the government deficit will be in 5 years' time, it is basically guesswork. I mean, let's just have a look. In the last full fiscal year, 2024 to 2025, at the beginning of 2024, March 2024, the OBR said the fiscal deficit in 24 to 25, April to April, will be roughly about £70 billion. It turned out to be nearer £130 billion. So even the in-year forecast for the deficit was out by a massive order of magnitude. And we're rowing, and what's influencing policy are forecasts to one decimal place about the same number in 5 years' time. It seems to me completely fictitious.
Well, it's the latest estimates have gone up even higher than that. For the last financial year, it was now over 150, over 5% of GDP.
And the original forecast in March of that fiscal year was 70.
Yes, that's right. And the same has happened with this financial year, whereby the current estimate is still pretty high. It's nearly 140 billion, but I expect it will eventually turn out to be 160 billion.
And that's the increase in borrowing in a single year. It's our annual deficit, which is then added to our debt. I feel the need to distinguish between debt and deficit because it seems there are political leaders in this country, political leaders who don't understand the difference between a debt and a deficit.
Well, I'm not sure that it helps policymakers to focus on the debt. If the debt is high, it's because of a lot of historical factors. They should be focusing on the deficit, which is the thing that they can properly control. But the significance of these figures is that we will have had last year a deficit of over 5% of GDP, this year a deficit of over 5% of GDP. We have not had that sort of experience outside of a major crisis like the global financial crisis or the pandemic since certainly the early 1990s. And it was that sort of level of borrowing under Dennis Healey, Labour Chancellor in the mid-70s, that brought on the 1976 IMF crisis. So I think that is really quite a worrying situation.
In general, Andrew Sentance, how would you rate the level of economic policy making in the UK? Let's not make it party political to finish with. Across the piece, since the COVID pandemic, how would you describe it, and how can we change it?
I think the seeds of the problems we now have on economic policy were sowed in the late 2010s, even before the pandemic. Clearly, the pandemic made things more difficult. But there was a drift away from the principles that had underpinned UK economic policy from the 1980s through to the mid-2010s. And successive governments have moved away from those principles. And we can see the evidence of what that has done in the growth figures. This is going to be the worst decade for UK economic growth since the 1920s.
Yeah.
That is for 100 years.
Yeah.
It's going to be the worst performance on inflation since the early 1980s. It's going to be the worst performance outside of the pandemic and the global financial crisis on public debt since at least the early 90s and possibly the 1970s. So we're really in a bit of a pickle, and we need a bit of a change in the approach to economic policy from both the major parties and any other party that might be in power after the next election.
And I know you take seriously your role as a commentator and an economist of some note. So let's just end, hopefully, if we can, on a more optimistic note. I don't know about you, but I'm still a huge admirer of UK's entrepreneurs. I think we've still got fantastic people across our workforce. I still think we are capable as a country of world-class economic activity across a range of sectors. What are your signs of hope, Andrew? Because I know in general you're not a temperamentally pessimistic person at all. So what are you looking at that gives you some hope that we can get through this? And do you think, Andrew Sentance, we can get onto a better economic path without a crisis? Or do we need a crisis to move the political needle to educate today's generation of political leaders that you have to take financial markets seriously? You have to take the government's funding requirements seriously.
I think what we need to recognise, both I think in the public debate and in the political circles, is that the real engine of success in the UK economy is the private sector and private businesses, and the entrepreneurial and the market-based approach that came into its own in the 80s and the 90s and actually underpinned pretty good growth figures until the pandemic hit. And that private sector generates about 80 to 85% of GDP and employment. And actually energising the private sector is the big challenge. And that's what's not being done at the moment. If business people are on the radio or the television or writing in the newspapers generally saying rather negative things, we need a much more positive approach to the business community. And I think that will deal with a lot of the problems we're now seeing in terms of growth and inflation and public finances.
Andrew Sentance, thanks a lot for joining me on When the Facts Change.
Very nice to do.
Thanks for joining When the Facts Change, economics and politics in a fast-moving world with me, Liam Halligan. Please subscribe to my YouTube channel and my podcast via Spotify or the podcast app. And above all, please subscribe to my When the Facts Change Substack.